Good evening, everybody, and apologies to our viewers today. There was a bit of a technical glitch which was there, but all that is resolved. So now we are going to have a very insightful discussion, with our panelists today. Yeah, I'm Abhijit Roy. I'm the co-founder CEO of GoldenPi, online platform for fixed income investments. For our first-time viewers today, right? This is the seventh episode of our GoldenPi's Industry Speak series, wherein we invite the rising stars, the trailblazers, and the behemoths from the financial industry in the country. We get in touch with their founders, the leadership team. We understand about what they're building in their company, the struggles, and the achievements, and in a nutshell, understand how they are reshaping the financial landscape of the country. And this is all to provide you with a solid understanding of the companies so that when there are any investment opportunities, you are better equipped to take a solid decision. So previously we have spoken to a host of financial entities on the lending space, some on individual lending, some specifically focused on SME based lending, some on micro enterprises, right? But today's story is around mid-market lending. Ladies and gentlemen, today we have a fantastic opportunity to learn about this space and how a new age NBFC is reshaping this market, revolutionizing it. Vivriti Capital. I have the pleasure of inviting to our show Mr. Vineet Sukumar, who is the founder and MD of Vivriti Capital and Vivriti Asset Management. Just to give a little bit of background of Vineet. So he's an industry veteran with 20 years of experience into the financial services. Prior to this, he was the CEO of IFMR Asset Managers Group and the CFO of IFMR Capital, where he scaled the business to $7.5 billion. He has got a host of industry firsts that he has launched in the market, like pooled loans. Prior to this, he had worked in Tata Capital and in Standard Chartered Bank in key investment banking roles. We also have Mr. Parth Sanghani, who is the Chief Treasury Officer of Vivriti Capital. Parth brings to the table over 19 years of industry experience, having worked across large financial institutions like Kotak Mahindra Bank and ING Vyasa Bank, where he has successfully executed deals worth over 15,000 crores. Welcome to today's discussion, Vineet and Parth.
Thank you. Thanks for having us.
My pleasure. Before we get started, Vineet, it was my pleasant surprise to discover that we share a common alma mater, IIT Kharagpur. So I graduated in 2003. I believe you are a couple of years senior to me. It's really great to have you on our show today.
Thank you. Always glad to meet a fellow KGPN.
Likewise. Cool. With that, so first question to you, Vineet. Whenever we've spoken to founders, there has always been some life-changing event or some kind of an observation which they had, which triggered them to start off their enterprise and passionately go after solving a certain problem. For your case also, you had a trailblazing career, corporate career before this. You were the CEO, you were the CFO, you had played key investment banking roles. But then you put all that aside and you started Vivriti Capital. There must be a very strong story behind this, right? We're all eager to know about what was that origination point or genesis of Vivriti Capital.
Didn't expect that question, but I'll put it down to a trip to Ladakh in 2009, after which I came back a changed man. But I think in 2010, I actually took a fairly large risk in my life. I left a very, very well-paying job at Standard Chartered Bank and joined a startup that was at that time called IFMR Capital. Later on, that would be renamed as Northern Arc Capital. And when I joined there, I was possibly one of the earliest members of the capital markets arm of that group. This was a group that had been started by Nachiket Moore and a team That was ex-ICICI Bank.
Right.
And when I was there, when I joined there, I was put in charge of treasury, later origination, later distribution, later fundraising, and later asset management, right? And that I think was very foundational for me, because it personally gave me a very deep insight into the mid-market space, the issues that that the space faced, what it would take to build risk management, what it would take to build market appetite, and finally, how could structured finance play a pivotal role in bringing access to debt to the space, right? And I think that really gave me the courage and conviction to start Vivriti. So after roughly 7.5 years at IFMR Capital, going through cycles, going through growth, going through a significant amount of innovation and scale,
Right.
I started Vivriti in 2017.
27.
Yeah. So
it's been 6 years of journey for you.
yes, six fantastic years. Can't complain. I think it's been one of the most difficult phases that the Indian corporate sector has seen, on account of pretty much everything that could have happened has happened, right? We
Right.
saw the when we started, we were just coming out of demonetization. GST had been introduced.
Yeah.
RERA was introduced. So dramatic changes to the Indian landscape, right? IBC was introduced in a significant way, right? Some time into the journey, and we saw AAA institutions default, right? And when we thought we'll recover from there, then COVID came up. So I think no shortage of excitement in the last 6 years. So it's been a fantastic journey, I think.
Fantastic. Fantastic. So for our viewers today, let's dive deep into this problem statement of solving for the mid-market space, the mid-market space lending, right? If you could elaborate this for our viewers today and explain how is it different from the traditional lending practices that we usually see from an NBFC, which is lending to an individual in the form of a personal loan or gold loan, or lending to maybe SMEs or micro enterprises. How is this different? And if you could elaborate on that front.
Sounds good. So let me first outline the space. It will become clearer, and then we can come to how it is different, right?
Sure.
So think of corporate India. You typically see large corporates, well-known companies, be it Jindals or Reliance or Tatas, etc., etc. Now, India has possibly 40,000 odd corporates that are registered, that have raised debt ever in their life, right? And that potentially report data to the Ministry of Corporate Affairs, which is the central repository for financial data in India.
Right.
Right. Now, out of that, we place a filter, which is minimum revenue of 100 crores. Okay. We place a second filter, profitability, 3 years of profitability. We place a third filter, which is consistent reporting to Ministry of Corporate Affairs for 5 years. Okay. After you apply these three filters, approximately 14,500 companies remain. This is as per data of March 2022. It's a little dated, but ballpark that's the amount that remains. Right? You also exclude AA and AAA.
Okay.
Okay. AA and AAA are well served by Indian loan markets, bond markets. Yeah. Right? There's no point in us spending time there. Right? So 14,500 companies remain after you apply these filters to the corporate bond, to the corporate market. Right? Now, these companies have an aggregate today have an outstanding debt of $230 billion. So large market, right? Let me put this in context, right? The microfinance market is approximately 45 to 50 billion dollars, right? 45-50 in microfinance, 230 in mid corporate finance.
Yeah,
right.
Literally,
housing finance is 350, 5 times. Housing finance is pretty much the largest market today in India at roughly 350 billion.
Right.
But mid corporate is the second largest, right? MSME, commercial vehicles, microfinance, consumer, all are smaller.
Right.
So that gives you a sense that it's a large market. Okay. Now we went deeper. That if there is enough debt in this market, what will we do? Right? Why should we exist? Right? And what we realized is that not only does access to debt matters, but access to quality of debt matters. Is there money for growth, or is the money only for working capital? As we all know, working capital allows a company to stay in the same place.
Right.
Growth capital means I need term debt.
Correct.
And we realized that 8,000 of the 14,500 actually didn't have any term debt. The balance 6,500 had very limited term debt, right? And our comparable is large corporate. In large corporates, long-term debt to short-term debt is 4 times, right? So that gives you a sense that access to term debt is a problem.
Correct.
Then we started looking at who are the providers. Is it largely informal sector and maybe more traditional lenders, or are you seeing more private banks, NBFCs, mutual funds, etc.? Right? And there also we found a huge disparity between large corporates and mid corporates. Right? So without belaboring too much on this question, but we realized that there is an access to finance problem, there is an access to quality finance problem, there is an access to term finance problem. And this is why Vivriti exists. We exist to be a term lender to mid corporates to unleash ambition and enable them to grow.
And right? I believe that with these credentials, if they approach a traditional banks, either it would not go through, or the rates of interest would be on the higher side, collateralization would be huge, right? And that becomes a pertinent problem to solve for this thick market segment of 100 crores of revenue and above.
Absolutely. I think these corporates deserve better. These are long-term stable models with fairly consistent cash flows, entrepreneurs who have seen a lot of cycles and survived, right? And they definitely deserve better. They deserve responsiveness, they deserve speed, they deserve customization, they deserve scale, they deserve term, right? And that's why we exist. Also fundamentally, and to answer your other question, how is this different from what we typically see on the NBFC side, right? Now, when you look at retail lending, auto, mortgage, LAP, consumer, MSME, right, education, etc., those NBFCs are solving for a problem of a very large number of borrowers, maybe lakhs, but the product becomes monoline, right? So everybody will get a 20-year home loan, or everybody will get a 2-year microfinance loan at 26%, etc., etc., right? So customization at a borrower level does not exist, right? For us, it's exactly the opposite. I have maybe around 200, 300 borrowers, not lakhs. But for every borrower, we have to constantly think about customization. So we may start with a term loan, we may give working capital, securitization, NCD, commercial paper, vendor finance, dealer finance, factoring, leasing, etc. I may give short-term, long-term, right? I may give facilities that are structured differently. Collateral may be different in each and every facility, although we typically lend secured, but nature of collateral can vary. So the level of customization is high because my customer is complex.
Got it.
So we have to therefore respond accordingly.
Sure. So I will, ask some detailed questions on these product suite also, which I think will be great for our viewers to learn from. So it'll be good to know about, from a very schematic level, the business model that is there. Maybe with an example, if it can be explained, like an entity comes to Vivriti Capital, it's looking for term loans. What would be the procedure? What is the due diligence that happens till finally it gets a capital, and how it repays back? In a nutshell, if that can be, put forward.
Sure. So Vivriti has specialized teams that deal with every stage of a customer interaction. The first is a client acquisition team. So we go deep into the country. This team goes deep into the country to find high quality corporates who need money. And therefore, the first port of call would typically be between the potential client and the client acquisition team, right? Why? Because naturally that company may not know Vivriti, right? And therefore they need to know who we are, what our credentials are, and therefore why should they work with us? What can we offer them? Right. Secondly, they also need to understand broadly what terms we will require to be able to lend to them, right? Rates, security, tenure, etc., etc. Right? Now, once there is a meeting of minds, right, the baton is then handed over to a relationship manager. The relationship manager then negotiates the terms by which we can engage with them and seeks to understand the company and that company's need. So our term sheet has to match the need of the company. Do they need money for capex, for working capital, for acquisitions, for marketing and expansion, right? Or for example, they would like to kind of refinance existing debt and make it more affordable, right? So there could be a variety of use cases, right? Now, very clearly, some use cases we can't support. For example, we don't lend to holding companies, right? We don't lend for special situations. We don't do startup funding, right? So these are the areas we definitely will not do, right? We want operating companies. We want to lend against cash flows. Yeah, and so that these terms are negotiated by a relationship analyst.
Okay.
We cross this stage, then we come to credit. Now, credit starts looking at the numbers very deeply. Within 7 days, data comes in from the company, and then we schedule an in-person diligence. One member from credit and one member from risk physically visits the office of the company, spends a day in the office, full day, meets the entire CXO team, understands their systems, ERP, etc. Spends one more day in their place of work, which could be factory, project location, customer premise, branch, etc., etc. Right? Now, these two individuals come back, crystallize their learnings, look at a lot of digital data as well, bank statements, GST, PF, litigation, bureau records, MCA data, right? And create a comprehensive credit profile, which is like a 70, 80 page report that comes to credit committee. Credit committee consists of my CRO, my chief credit officer, my CFO, and myself. We have to unanimously agree. Even if one person disagrees, the case doesn't go. Okay. Now, post that, the operations team takes over and constructs our facility documents, right? It's a digital process where there is a digital signature. So it's very quick. Security gets created, our money gets debited, and we disburse our amount. Post that, every quarter, we have to reassess the company and the credit team takes ownership for it, right? And every quarter, therefore, there is a conversation with the company to understand their numbers. There is reporting from the company, which gives us an analysis and insight into their business, MIS, and financials. And there is a re-rating that we do on the account on our internal rating model.
Got it.
Right? Now, what we try and do in this process is that eligibility, which is should we work with the company or not, is committee's job.
Right.
But beyond that, rating, limits, pricing comes off a model. So we try to make sure that we take consistent decisions, and the team also gets a sense that this is system driven and not people driven. Right. So this is the process we run. Now, door to door, if the company is cooperating and giving us information, we can actually fund them in 14 days.
That's a stellar time period, very, very, very short time period of fund dispersal in the happy path, of course. 14 days is definitely like it's one of the fastest paces that I've seen in the market personally with respect to the fund disbursal, because the due diligence time itself, and then finally coming up with the terms of the structure itself takes a lot of time. Essentially, I have seen companies that take time over months to actually come up with the final funding amount and the terms and conditions around it. So I think I'll pick up a couple of words from what you said last on the digital data and digitized process, standardized model, right? What I've observed is NBFCs today are leveraging technology heavily to, bring up their efficiency and bring down their costs, right? Vivriti is one of the key players that I understand in this mid-market lending, heavily driven by technology. It'd be great to know from you, what are the various technology things that you're using over here, and get a peek into your, technology stack, as they say, that maybe certain things that you have pioneered into this market space as a market leader.
I can't say whether we're pioneer or not, but we do have a fairly strong tech stack. We have in-house product development, technology, and data teams.
Everything in-house.
Everything in-house. We have taken a call largely to build and not buy, because we think that the kind of customization and products we need are not available in the market.
Right.
And we think that most of the innovation in technology happened on consumer lending, but not on enterprise lending, which is why we had to build our own. Right. What have we built? The first is that we have built product execution engines, right? So for loans, for bonds, for commercial paper, for securitization, for supply chain finance, we have built product execution engines. So these are typically workflows, digitized workflows that operate very fast and allow us to, churn our exposure and lend much faster. Also, the client gets a digital interface, which means that they don't have to sign 1,000 pages of paper. They can have a very seamless execution process. Now, to add to this, we have also built a strong tech integration engine, right? Now, this we use in two cases. One, where we are working with the supply chain, with an anchor for supply chain finance. Then we need to integrate with the ERP, The second is where we work with an NBFC for co-lending. Then we have to integrate with their LMS, right? So that's an integration layer on top of our own systems. That's number two. Number three is that our products are complex, but it has to come into a single accounting layer, right? So there's a bridge between product execution and accounting, which we have built so that the cash flows can be synthesized and transferred to our own Oracle EBS, right? The fourth is a credit engine, right? Where data of each and every company, each and every transaction is captured into a data lake. A profile of the company can be created, a report can be written, data can corroborate the analysis that we are doing, and our own models can run, rating, limits, pricing, etc. can run on that same system, right? So, product execution, integration layer, customer interface, credit, and finally our middleware, which is sitting between our execution and accounting. These are the areas where our team works on from a technology stack perspective. So most of our work is actually platform independent. So while we engage a lot with AWS, but at the end of the day, tomorrow if we have to switch to any other platform, we can do it immediately at a click, right? We've also invested a lot in InfoSec because we deal with highly confidential corporate data. It's extremely important for us to invest into InfoSec. And lastly, data lakes and data engineering and data science is very important for us because we get tons of unstructured corporate data which we have to read, ingest, and absorb and analyze, right? For example, I can be engaging with an engineering company, right? But I should be able to instantly compare that company with 5 other engineering companies who may not be borrowers of us, but there is data in public domain.
Yeah.
Right. So peer comparisons, right, is one example. Secondly, we can have early warning signals coming in from absolutely public data, like for example, has a company paid PF on time? Has a company made GST payments on time? If there are delays, we know that there's a liquidity issue.
Right.
And so on. Similarly, companies that share information with us, we can compare and contrast this quarter with prior quarters, current business with business plan, and we can actually generate a lot of outputs which tell us if the exposure is at risk or not, right? If a company is sharing 5 kinds of data, for example, financials, stock statements, right? The ledgers for their receivables, their inventory holding position, asset liability, liquidity position. I should be able to compare and contrast all of them to see if they're consistent. Now I cannot do it at scale unless I have an army.
Correct.
Right, and that's the role that technology plays, right? So efficiency, credit cost, and client experience. These are the 3 goals of our technology development, and I think we've come a long way.
Fantastic. So, one offshoot question of this is because you have built these products in-house, right? And especially that credit engine, right? I see a lot of NBFCs who struggle on that front because they're trying to do some algo on their front. Do you have any plans of, lending it as a service to others, other NBFCs so that they can use it and, the whole market grows with your, powered by your engine? Anything on that front?
So I think, to be very frank, that's a business model that we set up and spun out of Vivriti, right? Around 5 years back, we had around 3 years back, we spun out a company called Cred Avenue, which today is known by the name UB, the trade name UB. Which is actually a marketplace, right? So we were a 2-member founding team, Sukumar and myself, that started Vivriti in 2017. And in 2020, the marketplace platform got spun out, and that actually does what you do, what you said, which is running a credit algorithm at the back end, assessing companies on an ongoing basis, and creating a credit and pricing based market for these companies to raise debt capital from lenders on the platform. So yeah, you're right that was a big opportunity. We saw it and took it, and today it's a fairly large company in its own right. It's an associate company of Vivriti.
Got it. Next question to you, Parth. Right. So one is if we have to talk about the financials of the company, right? If you could share what has been the revenue and what has been the PAT for, let's say, the past 3 financial years, FY21, FY22, FY23, and what would be a NPA levels as of now?
So we recorded a profit of 129 crores in March 23, 67 crores in March 22 full year, and 30 crores is March 21. Gross NPA ratio, which is the asset at risk, delinquent more than 90 days, is 0.3%. It's
0.3%. That's phenomenally low.
And there are no restructured or rescheduled accounts on the balance sheet. So this number is a pure performance number.
So your gross and net match at 0.3, basically.
No, gross is 0.3, net is 0.08 March 23.
0.08%. Cool. On that front, I mean, on this NPA front, if I have to extrapolate this, right, what are the various due diligences and risk assessment that you would do, right, when you evaluate an entity before disbursing a loan, right, and then empower that company with various other, funding lines, right? Like Vineet mentioned, the whole plethora of funding that goes to, an entity which is doing well. What is it that you would do on the due diligence front? What is the risk mitigation or risk management that you would do over here?
I think that's what Vineet covered, that we have a rating model and every single company in the portfolio is rated on a quarterly basis, right? And that allows and that model decides what is the exposure and what is the tenor that we can take on that company, right? So every quarter, after the performance of every quarter, the company is rated and the limits are available in the system, right? So tomorrow that the company would have taken money from us 1 year back. Right. It might plan to take money from us 6 months hence, right? But still it is monitored on a quarterly basis, right? So that's what Vineet covered, that it's a rated internal proprietary model, which is designed to bring out what is the exposure that we can take and what is the tenor of that exposure that we can take.
Cool. So, Vineet, would like to understand what is your perspective on this mid-market space? How do you look at it, going down the line? There are other players. You also have peers in this space, right? One question, which I always ask founders is that what is a key differentiator that Vivriti has that, makes you stand apart from the rest and make you, lead the pack?
Sure. So I think if you look at the lending market, I think those that do well are the ones that specialize, right? So think Muthoot for gold loans, or let us say Credit Access Grameen for microfinance, right? Or let us say a 5-star which recently listed for SME finance, right? So when you think of companies like these are specialists that have done a fantastic job at building scale with a very tight competitive advantage built over years, right? And we would like to be similarly known for mid-corporate lending, right? So we are a specialist, and because we're a specialist, our product, our technology stack, our people, our engagement, our relationships, our distribution and presence, all of it is attuned to that customer segment, right? And that's what has helped us constantly stay ahead of the game and remain relevant for our clients, as well as build a much larger spread of clients across geographies, right? So I think the mid corporate space is poised for a lot of disruption, not only because the credit is holding well, but also because I think steadily we are seeing many signs that investor appetite for this market is deepening. For example, we have seen, our own asset management company has done well in raising external capital for our mid-corporate focused funds. And we're seeing that happen in the market in general as well. We are seeing online bond platforms taking mid-rated corporate to the bond markets to their investors, right? We've seen also from a credit perspective a significant upswing. So sectors like power, renewables, cement, steel, engineering, manufacturing, logistics, roads, ports, marine infra, airports, civil works. All of these sectors have benefited from government policy, government's capex push, international risk appetite, as well as India's favorable macro position, right? And that's why I think this space looks now very, very, very exciting for a player like us who sees significant opportunity from this market. So I'm quite encouraged. I think we are possibly at the best position that we have been in the last decade or so. There is a positive capex cycle. There is a huge data infrastructure that allows us to understand risk well, and capital markets are also responding well in terms of risk appetite to fund the opportunity.
Right. A follow-on question to you, Parth, right? On this front, slightly more delving into the details on this. See, one of the key challenges for an NBFC is the collection engine, right? How do you recover the loans that you have given, the timely payments happen and all that, right? What's the kind of structure that you have to ensure? I understand that it goes through a filtering criteria of the credit engine, which actually evaluates an entity, and the deserving ones only get it, right? But then reality can be different at the end of the day, right? So what's the kind of structure that you have on the collection side, right, which ensures that you are being able to keep this wonderful NPA of 0.3%, right?
I think I'll let Vineet I'll let Vineet take that. He can dive a little deeper into this.
Sure. So I think what's been important for us in the context of corporate lending, Abhijit, is that we have to think differently from retail. In retail, we will have a separate business team, credit team, collections team.
Right.
Because retail collections is more granular, and the ticket sizes are very, very, very low. Right. And there is no relationship. There's very, very limited relationship that you have when you're doing a retail facility. In corporate lending, however, it's very different because A, you need to have patience with business cycles. B, relationship plays a very significant role, right? And C, ticket sizes are larger, right? So in Vivriti, the business team is responsible for collection also, right? Because they have the best rapport and understanding of what situation the borrower is facing. They're also able to face up to the borrower in difficult situations and negotiate our own position, right? And finally, they are much better informed than in terms of what might be going wrong with the company given their own position of engagement with the company, right? So business remains responsible for collections, and that's how the KRAs are set in our organization, right? While risk and credit remain responsible for a tight review, assessment, and understanding of the company at any given point of time. Right. We also have given dual responsibility of collections to the risk team. So the moment a company goes into a slightly difficult situation, the account starts getting monitored by the risk team on a monthly basis. Until that point of time, it is monitored by credit quarterly. But the moment we see something going wrong, it is monitored monthly. When I say something going wrong, I'm talking about deterioration, not default. Right. For example, like I said, PF is not paid. That's a liquidity problem. Right. Immediately, account moves. Right. Or for that matter, we see that a company is consistently borrowing very high cost debt. Right. That's a problem, and automatically the account moves because an early warning trigger has kicked in.
Correct.
Right. So so the business team is responsible for recoveries. The risk team gets responsible for all high risk cases with a very, very tight monitoring mechanism, and that's how we manage to collect money.
Got it. I think, I mean, one key learning for all of us over here, is this structuring, which is very pivotal. That the business team, the sourcing team, is also responsible for the collection itself, and the KPIs are set accordingly, right? And then you have your internal due diligence engine, and the team responsible to continuously review the company and early signs of any kind of issue that your system drives. Your system gives those early signals. So that's definitely a strong moat which has been built in, and which explains the 0.3% rate actually. So moving on to the next part, which is like Vivriti Capital is raising funds through the debt IPO. So for our viewers today, we'd be interested to know about the details of the issuance, the quantum that is being raised, the coupon rate, the ratings. If you can share details with our viewers today?
Sure. So we have actually raised more than 2,000 crores of bonds till date, but all of them have been through the private placement program.
Got it.
Having said that, we have actually brought in a large number of institutional and HNI investors. Today, more than 1,700 HNIs are investors into the bonds that we have raised in the past through private placement. Right now, it is our endeavor to very sharply expand this investor base, because we need to see that kind of expansion happening as we grow larger and newer and newer pools of capital start getting accessible to us, right? So that's why we saw this as a good diversification opportunity on our liability side, right? Now, the issue itself is expected to be a total amount of 500 crores, so 250 crores base, and the balance is green issue, right? We have tried to make the issuance very, very friendly to retail investors by capping tenure at 24 months, right? So we have 18-month series and 24-month series. Within that also, we have kept two kinds of cash flows. One is where the coupon is annual, which means that the investor would not like to take reinvestment risk. They would like to lock in at a high level. Or the coupon is monthly, which is when the investor wants to see cash flow more frequently, right? So 18-month monthly, 18-month annual, 24-month monthly, 24-month annual. The last option is interesting because it appeals to investors who have a very short duration commitment, maybe because of their own finances, etc., etc. So there is a 24-month option where it gets paid down in 8 quarterly installments on principal also.
Got it.
Right.
It's a staggered maturity.
So it'll get 1,125 rupees back every quarter with interest. The average maturity comes down from 24 months to 12 months of duration.
Right.
So these are the 5 series that are available in the issue. It's a secured bond for a tenure of 18 and 24 months. The security is the receivables that we have on our balance sheet, which is really how all our debt has been secured so far.
And what is the coupon rate? What is the highest coupon rate?
So the highest coupon rate is 10.5, which is for 24 month annual coupon. Right, that's where the highest coupon is, which is at 10.5.
Understood. And what is the credit rating of the papers?
Yeah, so we are currently rated dually by both ICRA and CARE, and they have both rated us at A.
Got it. ICRA, CARE, both rated A. Okay. So just to summarize for our viewers, so Vivriti Capital is raising funds through public issuance of debentures. The biggest advantage for retail investors over here is that you can apply at as low as 10,000 ticket size, right? And you can apply through the UPI route, right? Everybody has got, UPI payment apps. It becomes very easy to apply over here. The previous route that Vineet mentioned, private placement, right? There, the minimum ticket size as of date started in January 1st, 2023 is at 1 lakh, right? So here in public issuances, retail can comfortably participate with as low as 10,000 with multiples of 1,000 on top of that. 250 crores is being raised as a base issue size, 250 crores green shoe option, overall 500 crores, and 4 variants over here, monthly, annual, 18 months, monthly, annual, 24 months, and one last option, which is basically a staggered maturity, wherein you start getting back your principal over 24 months, wherein the fund that you have deployed, effectively you'll get it back within 12 months rather than 24 months, right? Your duration, which is termed as duration, it comes down, right? So, and the highest rate, interest that you get is 10.5%, fairly above whatever you have, as the traditional fixed income options, which are there in the market. The bonds are rated at, by 2 credit rating agencies, ICRA and CARE, at A. And these are secured bonds, and I believe senior bonds as well, right, Vineet?
That's right.
Cool.
Senior secured.
Sure. Senior secured bonds or senior secured non-convertible debentures investable at 10,000 ticket size, purely meant for retail participation. And what would the funds be used for, if you could share that?
Yeah. So, Abhijit, I think we are on a growth path, and therefore, and money is raw material for a company like ours.
Yes.
Right?
Yes.
So the vast share of deployment will really be towards growth, which means either finding new clients to lend to, or servicing existing clients for other needs beyond what we have done already for them, right? So most of it will really go towards that, while the prospectus allows us to retain 25% for general commercial, general corporate purposes. But at the end of the day, I think most of the money will really go towards growth.
Understood. Understood. Cool. One last question. So how are you foreseeing the future of Vivriti? Any plans to, diversify across your product offerings, your customer segmentation, or, getting into new business streams? Like you mentioned one point, which I've heard before also from NBFC leaders, monoline business, not to have a monoline business, right? And you have built a diversified one. Are you looking at further diversification, right? What's like the future vision you have as a founder?
So we are monoline on customer segment, which is mid-market. We are diversified on entity, geography, and product.
Understood.
Right.
Understood.
So if I break it down, we have a business that is around term lending and institutional lending for corporates, which is loans, working capital, lease, and let us say bonds. Right. Then we have a supply chain finance business where we lend to the dealers and vendors of these corporates. And then we have what is called the retail co-lending business, where we co-lend along with NBFCs to create a retail book, to help them create a retail book. Now, in all these categories, our fundamental relationship remains with the issuer.
So, Abhijit, I'm looking at some questions in the chat window. Maybe I can quickly start answering them.
Yeah, I think we can get started.
Kumar, so total share capital reserves, so net worth of the company as on March was 1,550 crore plus, right? Loan is 5,800 crore asset book, the total assets under management. What's the growth projection and loan book growth you are expecting in current FY? Being a public issue, we cannot give exact forecast numbers by SEBI guidelines, but the kind of growth that you have seen us in the past, which is way above industry average, will continue on a very fast-paced trajectory. What's the average ticket size? 3.5 crores. So in the enterprise book, which is the mid-corporate book, it is close to 15 crores, and in the supply chain around 1 crore. So therefore, a mix of plus there is retail co-lending, which is a lakh or so. I think 3.5 crores is average ticket size. In series 5, I can see 10.5% as the coupon. My question is, if I want to sell in secondary market this bond, what is holding period for seller and purchaser? There is no holding period. This is a listed, rated, senior secured NCD. So you can, after buying, you can actually on the same day, within an hour, you can put it up in the secondary for sale.
Right.
I guess GoldenPi will also allow that. So there is no restriction on the kind of holding that you have to have on the paper. You mainly lend to MSMEs and not to individual lenders. Individual lenders, yes. So individual lenders is the co-lending business that Vineet mentioned.
Just mentioned. Yeah.
Which is retail, and otherwise it is mid corporates. MSME, the definitions are very, very grayish. It falls in the very gray area. But we typically lend to corporates who have a top line or revenue of 75 crores going as high as probably 2,000-3,000 crores.
Right. There's one more question over here. What is the debt to equity ratio for the company?
Yeah. So March debt equity was 3.1 times. 3.1 times.
Got it. Got it. I think with that, we have covered most of the questions.
The chat window, at least we have covered.
Yeah. Overall, we have covered more or less all the questions that were there, mostly around, your lending model, how you have grown rapidly, and around the debt issuance that we have. So just a quick recap for our viewers. Vivriti Capital, one of the marquee NBFCs that is reshaping the mid-market lending space, lending to companies who have got a revenue of 100 crores and above. So these are companies with very solid, business models. They undergo a very strong due diligence through the model that Vivriti has, right? The NPA, which is basically non-performing assets, right? Wherein companies are not paying back. That's like 0.3%, one of the best in the industry. The company has got 129 crores of profit after tax in the last financial year, right? And public issuance of debentures are being launched by Vivriti at ticket size of 10,000 and above, right? Senior secured listed debentures. And I think one popular misconception amongst a lot of first-time investors is that what is the minimum period for which I'll have to hold the bond? There is no holding period for listed debentures. The day you purchase, the very next day, you can put it up on the exchange for selling, right? Or through the OTC route, you can look for buyers, right? So there is no holding period for NCDs. And what is, the date on which, the IPO opens up for, for investors to apply?
Tomorrow.
You open tomorrow.
We are open tomorrow.
Yeah. So that's like it, guys, right? I mean, it opens up tomorrow, right? Vivriti Capital launching its public issuance of debentures. All the very best to you, Vineet and Parth, right?
Thank you.
For your issuance, and thank you so much for sharing wonderful insights into this NBFC space and the work that Vivriti Capital is doing in reshaping this market, right? Thank you so much.
Thank you.
Thank you.
And thank you to all our viewers, for participating today.
Investments in debt securities are subject to risks. Read all the offer-related documents carefully.